Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative, here for the last week in Mortgage Today, our weekly whirlwind through all things mortgage industry, as I am every week, joined by one of our members as my co-host. And this week, I am thrilled to be joined by one of the truly great leaders and people in our industry, President and CEO of Hallmark Home Mortgage out of Fort Wayne, Indiana, Deb Sturges. Deb, thanks for joining me.
Thank you for the invite. I really appreciate it. It's great to catch up.
You know, when you get the repeat invite, you've done well. So
Thank you. So if I screw up today, you won't be talking to me this year? Is that?
No, I don't think that'll be the case. All right, well, we got to start with the Super Bowl, and you know, the weird last year. I mean, I didn't think it could get any weirder, but the streaker scoring more touchdowns than Pat Mahomes and the Kansas City Chiefs. Who saw that one coming?
Yeah, what a game. It was. The game wasn't as exciting as what the commercials were. So you all know Chrissy Buchanan, who's my operations officer. She and I went into a pool and we had to pick the scores, and we nailed Tampa Bay, but we didn't think that the Chiefs would only have 9 points. So we got half of it right, which meant we lost. So
Unbelievable.
Yeah.
And what are you, a Puppy Bowl person? Take any of that in?
Not really. It was cute. I mean, it was cute, but yeah.
And you know, mortgage industry commercials, guaranteed rate, Rocket, Quicken, whatever they call themselves now, United Wholesale. I mean, they were all over the place. And any commentary or thoughts on any of the commercials from our industry?
Well, you know, it's great that they have the budgets that they can afford to do that. And I think in particular, Rocket's commercials have grown in you know, from when they first started advertising. I mean, they had a great commercial. I kind of Googled what people's top commercial was, and they were kind of up there on the top. So good for them. I think it's great to have the mortgage industry represented, and you know, people sitting out there thinking, gee, is it time to refinance or buy? We hope they'll call their local lender instead.
Right,
But
because I mean, now 4 years ago, the Super Bowl 4 years ago, at the time Quicken, push button, get mortgaged, right? That really kind of set our industry in a new direction. I really point to that one commercial, right?
It did. I mean, I can tell you how many mortgage owners, companies owners were sitting back saying, dang, they beat everybody to the punch on that in such a big way. And what, you know, the rest is history. But yeah, that was a moment that we'll never forget. Me too. I agree. It was amazing.
And now they've grown the largest lender in America and the number 2 lender in America, also in the Midwest with me and you, in Michigan. United Wholesale Mortgage rose to the number 2 lender in America, exclusively wholesale, buy from broker channel. Any thoughts on, like, who would have saw that coming? I mean, they were, you know, they were growing, I guess, 4 years ago. And they're such fierce rivals too. And they don't even try to hide the fact they don't like each other. It's really amusing to me.
It is amusing. And it's funny how all these companies are kind of located in our area, but you know, you got to hand it to them. I'm not going to sit and say anything negative at all, you know, about their platforms, but you know, I think they're an early investment in technology. It has you know, really paid off dividends for them. So I know both of companies have been infused with outside capital. I always wonder how much of that is a good thing and how much of that is not such a good thing, because suddenly you're not reporting to your own folks, you're reporting to a board of directors, and are your people thinking about what their stock prices are worth versus looking at what they're doing that day. And you know, I wonder, you know, how that parallels with their growth, and also what the negatives might be on that, because it's not, you know, I love Stratmore. I like to read their information because I think they really have some really good points. But, you know, they had an article recently and they were talking about, you know, is doing an IPO the end all? And their answer was, no, it's not. Generally, it's done to, you know, take out early investors, to for a variety of reasons, and then suddenly a company's structure, their strength, maybe their strength is their CEO that sees opportunities. They're worried how the analysts are going to be looking at it from a risk standpoint. So it would be an interesting study to see the good and the bad of those IPOs.
Absolutely. Rich Swerbinsky with the Mortgage Collaborative here with the Last Week in Mortgage Today. Pleased to be joined by President and CEO of Hallmark Home Mortgage, Deb Sturges. And Deb, I've worked for lenders that were publicly traded companies, those that were private. You make a great point. It's a huge difference. And we know, you know, I mean, the benefits are you raise a lot of money, you raise a lot of capital that can be used to scale, to grow, to acquire, to invest in technology. The flip side of that is, you know, you're no longer in, you know, I think Rocket's case is a little bit different. Dan Gilbert still owns, I think, 92% of the company, but now you're beholden to shareholders, and it's a whole different world, a whole different ball of wax. And I'm always curious to get, you know, just the perspective of CEOs like you that run kind of medium, large size independent mortgage banks on that dynamic. You know, the Rocket stock price, I think they IPO'd at, I don't know, around $20. It went up to like 35. They're back down to around 20 now. United Wholesale went public via SPAC. It got up to $13, $14 at one point after they switched tickers and went under UWMC. I looked this morning, they're down to $9. This is after reporting just astronomical profits, billions and billions and billions of dollars in profits. If you read the analysts, Rocket's model has always been very heavily tied to refinance. United Wholesale, they are betting hugely on the broker channel. Curious, your perspective just on the mortgage broker channel in general, depending on who you talk to. Some will say the market share is as much as 25, 26% right now for brokers. I personally don't believe that. It's more probably in the 15, 16 range, but regardless, I think it's as high as it's been in a long time. How do you view the mortgage broker and that channel from a competitive standpoint?
Well, you know, I've never walked a mile in those shoes, but I do have some colleagues, or excuse me, some peers that are in that space, and I think it's a real interesting how they, at least what I'm told, is that it's more the speed of the technology of where they choose, because they'll have, you know, they'll have Quicken, they'll have United, they'll have any number of them. And it's what I hear, it's more the technology interface piece that leads them towards using a particular company, sometimes over price to the customer. You know, that's anecdotal. I don't have any, you know, sound proof of that, but, you know, a couple of people that I know, they really say that the technology piece can be very clunky with some lenders, really clunky. And the ones that have figured that out, United Wholesale in particular, I think that's helped them grow their market share. I really do.
Absolutely. It's
And it's
fascinating.
great. Yeah, it's
They
great.
build the technology and give it to the brokers, and that they do that to try to build that stickiness. It's interesting model, and one that's emerged.
Yes, it is. And to develop your own platform, which they did. I know Quicken did. There are others that did. That's capital intensive.
It really
And
is.
you really have to be at a certain scale
Yep.
in order to do that. So then there are all of us. And we're still doing the lion's share of the business if you look at any of the stats. So
I agree. And I think it's a risky, I do feel like, some of these companies, ones we've talked about and others we haven't, like they're betting almost a little too much on the broker channel. The history of that channel is that it kind of caps out at a certain level and fluctuates. I believe there are reasons for that, but it'll be interesting to see how it plays out. A couple reminders real quick before we go forward. One, interactive program as always. Any questions, comments, thoughts, anything that anybody has for Deb and I, please feel free to pump it into the chat or the Q&A and we will voice it aloud. Also, coming up here just in 45 minutes, we have a really incredible session coming up at 3 p.m. Eastern right here on our TMC Connect platform. You can register at the link is in the chat. Called the DC Pendulum Shift, what a Democratic-led Capitol Hill means for banks and IMBs. TMC partner, ArchMI, one of their senior leaders, Kirk Willison, really plugged into that world, is going to be talking with one of our members on the IMB side, Tim Ross, and Brian Traylor, one on the bank side. Should be a great episode and one that you can register for at the link in the chat. Good segue, Deb, to move on to some of the changing winds in our industry with the change in the presidential administration, with the Biden administration coming in. We've got a new CFPB, and this is going to be a whole new world. Elizabeth Warren, who really is passionate about consumer protections, her kind of handpicked appointee is going to be taking that bureau over. And just a lot of chatter, consternation amongst our members about what could be coming down the pike. As a business owner, how are you viewing that?
Well, two thoughts, relative to the new administration. I think it's real clear that Biden is going to be really focusing in on a racial equality and home ownership for everybody. Kind of addressing the instability in housing for certain populations. And so that being said, and I think so far Biden has shown that his commitments during the campaign, he's serious about rolling them out. And so I think we should take all this very seriously, especially as it relates to the CFPB. And of course, the change of directorship is going to be huge. I think you're right. I think it's kind of going to be on the Elizabeth Warren mold, and Director Ogio has made it very clear that fair housing and racial equality is going to be at the top of the list. And so we need to, if you're as a business owner, if you aren't ready, you need to be, because the additional HMDA data that is required makes it very easy for them to go in and take a look at your numbers. And it's not as if they ask a lender for information, the lender gets back with them. They can see it. And so, every lender needs to be taking that quite seriously. And by that, I believe that you really need to be looking at where you're getting your applications, gender, race, authenticity, and where those applications are coming from compared to your peers, to ensure that you're not skipping over areas. You need to be employing a more diverse workforce, in particular loan officers, who can help with that diversity. So inclusion is real, and you've got to walk the walk. Not only do you have to walk the walk, Rich, but you're going to have to be making the needle turn in terms of your HMDA data. So, do the right thing, document what you're doing, and then we put an ad hoc group together about a year ago, just specifically to talk about this. And we looked at areas in our own, backyards to see where we needed to really do more outreach. And so, document that. We're watching the numbers closely. It's serious, and they're stating that it's serious, and it's their number one priority, or at least right up there with their high priorities.
Good
What
night.
are you hearing? What are you hearing, Rich, from other members?
I think you hit the nail on the head, and I see a lot of our depository members that are on the line live now, and haven't been in that world before, haven't been through fair lending audits annually for the last 10 years of my lending career. It is a very serious thing, and it's something that IMBs have not had to really deal with yet. I think as the CFPB, the end of the Obama era, they put the changes in with the HMDA data. Why are they collecting more HMDA data? They want to see the characteristics of your borrowers and your applications, right? And they, to make assessments on who you're lending to, and just having been a part of those fair lending audits, I mean, they're really looking at two things. They're looking at where your applications are coming from, and does the HMDA data mix of your applicants match, at least to some degree, the demographics of the areas that you're taking applications from. And then on the credit side, are you affording equal credit opportunities to all races, creeds, demographics as well? And I think our smartest IMB members, yourself, definitely in that camp, they're all saying the same thing. They're saying exactly what you just said, that this is something that's very serious. It's clear the direction we're going, and that we have to really do proactive things inside our organizations to prepare for this. So.
And I think even it boils down to even price exceptions that are being requested, which go on daily. For those of you on the call, that we have to be mindful about where and when we are giving exceptions, and the effect that will have on data as well. So, and then all the underwriting, the underwriting equality throughout. I'm not concerned at all about that, but just kind of our eye on the ball relative to when people are asking for pricing exceptions. So it impacts a lot of areas in the business. We're taking it very seriously, as I'm sure most people are.
Yeah, absolutely. I mean, my background was capital markets before going into more senior roles in lending. And I could tell you right now, I had a spreadsheet that I kept with tracking every price exception, what loan originator, what the exception was, why it was made. That was one of the first things that the auditors asked for when they came in to do their fair lending audits. So. Rich Swerbinsky with the Mortgage Collaborative, here for the last week in Mortgage Today, joined by Hallmark Home Mortgage President and CEO Deb Sturges. Deb, let's turn our attention to a slightly more optimistic topic, especially for us Midwesterners. Starting to see the columns popping up, and not a lot of hard data yet to support this, but the general consensus is that one of the byproducts of the pandemic, I think the one column that me and you were kind of batting back and forth, I think, was NPR, that was making projections that between 15 and 25 million people that otherwise would not have moved will move their home location, move states where they live, where they reside, obviously citing work from home, not needing to live in the city where your company is headquartered is the main reason. A lot of the speculation is that some of that relocation will be away from higher price cities on the coasts and to more some of the major Midwestern cities, Indianapolis, Fort Wayne, Cleveland, Pittsburgh. Your thoughts on that topic?
Well, yeah, I think you shared that article with me, and I'd read some other articles, but there are unbelievable amounts of people that are leaving higher cost city locations where they were tied there because of their employment. And I think through the pandemic, people, people have, well, companies, first I might say, companies have gone through a real um, evolution, if you will, and how we look at our workforce and our workforce from home. I know personally, I was like, oh, well, that'll never work. Well, guess what? It's working, and it's working pretty well. Knock on wood for now. So I think what you're seeing is companies that are open-minded to where their employee base lives and works. And so that opens up people to relocate to where they can afford. I think also one human part of all of this, Rich, is that, I think that through the pandemic, people have really started thinking about their family, their extended family, and really what that means to them and how they're able to integrate their work into an environment where they're closer to the family. I love to share this story. I have an employee, and she's kind of in that senior manager, not quite in the senior manager, but she has a very important role within Hallmark. This girl has 8 kids. I can't believe that, really, but she has 8 children. And she said to me one day on a Zoom call, she goes, I just want you to know how much I appreciate working from home, because when my kids get off the school bus and they come in and I can say to them, how was your day? She goes, that means everything to me. And and she responded, I put a poll out to all the employees. This was, I'm going to guess 4-5 months ago, and just ask them how they felt. Are they more comfortable at home? Would they like a hybrid model? Do they want to come back and work in the office? And I would say that the majority wanted something somewhat of a hybrid model. And but there are many of them that said they love what they do. They love being home, and they feel like they're just as effective. I know they are, because we know that we've got ways of really monitoring productivity. And so I think it's there are some good things that came out of the pandemic, and certainly that is one of them, is that people are opting to want to be with their families, extended families, and now they have opportunities that were not there before. And I think there's an optimism that will continue. I kind of share that optimism, meaning, let's just say that the vaccines get out and we can look back a year from now and it's it's under control. I think we all come out with a different way of looking at our workforce. So that's a good thing.
I agree. I think you're right. I think a lot of positives will come from all this, and hopefully we're back to somewhat of a more normal climate, and can appreciate that a little bit more. So with Deb Sturges, CEO and president of Hallmark Home Mortgage, with the last week in mortgage today, we have just a few minutes left. If anybody has any questions, comments for Deb or I, please feel free to drop them in the chat. Deb, want to turn my attention to just technology in general, borrower preferences, borrower facing tools. Have you seen any trends develop or emerge on the borrower preference side? And in general, how have you handled like upgrading your internal company tech stack through such busy times this last year?
Well, I think Hallmark, just like probably other companies, we had our hands full for a period of time, that talking about doing anything to to change our systems was it was falling on my deaf ears. And but we have a now that the dust is cleared, and it's really interesting. I read an article the other day that said that buyers would rather have an easy interface with a lender over the price of their loan. And I've read that a couple of times. And so we have a digital platform, but we haven't perfectly built out our closing platform, which we are in the process of doing. And we expect to be fully integrated by the end of this year. So that's one really big step for us. We really had hoped to have that done last year, but we really did not have the capacity to be doing those things in light of the production levels and how we had to have all hands on deck. Another area is we feel that artificial intelligence is shifting to a more task-based workflow. And I think that's providing operational efficiencies versus a linear. And it'll make a better experience for not only our customers, but our employees as well.
Absolutely. Last topic I want to touch on with you, Deb, is just work from home in general. We touched on this a little bit before, and I think what you said echoed what we're hearing from a lot of our members is, that the work from home is working. I think by all measures, productivity is up, from a year ago at this time. And but people want to still be able to work from home, right? But they want some sort of hybrid model. They want to still be able to get together. What do you think that, like, if you could, the crystal ball a year from now at Hallmark, what do you think just your workforce looks like in terms of work from home, in person, and how you manage that mix?
Well, I think looking forward, we're certainly not there. And I would say if I would be pressed today to say that we are going to return to some new model, whether it's a hybrid model or we'll stay working from home or we'll go back to the office, I don't think that's probably ultimately what's going to happen. But I would say if I were asked today when we would even be considering that new model, I don't think we're talking before October because of the vaccines, these variants. There's just a lot out there that still we need to make sure that our employees are safe and our customers are safe. But I think we're gonna end up with a hybrid model, and that hybrid model will probably be something like, some staggered employees, in departments. I think it's going to be very important that leadership is around our staff. And so if we say Wednesdays and Thursdays are the day you come to the office, then we've all got to commit to that. Because I think it's really important. And I think it spurs creativity too when we can be face to face. It's different than just, right here when you've got a group of people in a room. There's that interaction that, it does happen a little bit on Zoom calls, but not quite. So, I don't know exactly what it'll look like, but I can tell you I'm completely open-minded to the concept. I think we're out another 6 months to 8 before we have to make that decision. I'm certainly looking at, as leases expire or come to an end, we're looking at our space and trying to figure out whether we need less space in that situation or we just need to reconfigure the space differently. So, it's coming up, and I'm trying to do as much reading outside of the mortgage business to try to get as much information as I can. There's one company that's located in Fort Wayne, and they have a lot of, it's Vera Bradley. Everybody knows that luggage, that that soft, colorful luggage, but that business was started in Fort Wayne by two ladies, and they did an IPO a few years back. But But they have talent that they've, brought into Fort Wayne over the years, and they have gone to 1 week a month. The people are to be in Fort Wayne, Indiana. So a lot of those people have actually left. I know one family really well. They went to Dallas because that's where their families were from. And so, I just think having an open mind, it might not be 2 days every week, but maybe it's 1 week every other week. I'm just really open-minded to what's going to work. And, listen to your employees, because they'll tell you they're the ones that are living it, and they're the ones you need to listen to before you strike out on your own. So we'll be doing more surveys.
Sounds like a smart plan. And yeah, speaking of listening to your employees, we have a comment in the chat. It looks like from a Hallmark employee. It is, our companies like Rocket, Quicken, and United Wholesale subject to the same federal rules, regulations, et cetera, as our local lenders. I'm new to the business. And by the way, I love working for Hallmark Home Mortgage, and I'm looking forward to meeting Deb Sturges in person. And I think the answer to that is the brokers themselves are regulated on some level differently, but the people they broker the loans out to, like Rocket and United Wholesale, they are regulated the same way a Hallmark home mortgage would be, right?
Correct. Yes.
And all right, well, Deb, I want to thank you again for joining me in the co-host chair, and always enjoy talking business with you. And hopefully we can get things back to normal. I'm sure you guys will have another fabulous year at Hallmark.
Thank you, Rich. I appreciate sharing time with you today, and everybody on the call. Thank you for dialing in. And it's too late. I watched a Curb Your Enthusiasm. Larry David said, after 3 days, it's too late to say Happy New Year, but I'm going to break all the rules and say Happy New Year to everybody, because I haven't seen anybody.
I can't wait for that as well. And just a couple quick notes before we depart. Again, just a reminder, in 25 minutes at 3 p.m. Eastern, really great session that we have coming up titled DC Pendulum Shift, what a Democratic-led Capitol Hill means for banks and IMBs, taking a deep dive look inside some of the regulatory changes we could see coming with the new administration. Also, just a quick note about the new episode I do with Rob Krisman every other Friday, coming up this Friday at 2 p.m., The Rundown with Rob and Rich. Really pleased to be joined by our new sponsor for that episode, Partners Credit. Tracy King Donadio will be joining Rob and I, making that a three-way conversation. And she did that with us at the 12 Days of TMC, and it went great. So excited for that. And then lastly, our Community First Working Group is a really great working group. They have a call this coming Thursday, I believe at 2 or 3 p.m. Eastern. It's a group of CRA officers, community lending leaders from within our lender member organizations. It's a really great group that's been interacting together for years now, and that is coming up on Thursday. So with that long-winded plug, I bid adieu. Deb, thank you once again, and hope to see you in person sometime soon here.
Thank you, Rich. Appreciate it.
Have a great afternoon, everyone. Same place, same time next week for the last week in Mortgage Today. Thanks, and have a great day, everyone.